Understanding Marginal Utility, a comprehensive guide. What is marginal utility? Marginal utility is an essential concept in economics that refers to the additional satisfaction or benefit a consumer receives from consuming one more unit of a good or service. This principle helps economists assess consumer behavior and decisions, particularly in relation to how much of a product people are willing to purchase based on the happiness it brings. Key takeaways. Marginal utility defined, it's the added satisfaction from consuming an additional unit. Decision-making tool, economists use it to analyze consumer purchase patterns. Positive, zero, or negative, marginal utility can take on different values depending on consumption levels. Diminishing returns, as consumption increases, the additional satisfaction gained from each new unit tends to decrease. The law of diminishing marginal utility. One important aspect of marginal utility is the law of diminishing marginal utility, which posits that the satisfaction gained from consuming additional units of a good decreases as consumption increases. This law is crucial for understanding consumer choice because it can illustrate why consumers may only continue to buy a product up to a certain point where the cost equals their perceived value. Implications of diminishing marginal utility. 1. Consumer behavior. Consumers will evaluate whether to purchase additional units based on the marginal utility compared to the price they have to pay. If the marginal utility drops to the level of the price, additional purchases will cease. 2. Demand curve shifts. As utility declines with increased consumption, the demand curve for goods typically slopes downward. Consumers will buy more of a good only if the price decreases. Types of marginal utility. 1. Positive marginal utility. This occurs when the consumption of an additional good increases total satisfaction. For example, enjoying a second slice of cake after savoring the first one. 2. Zero marginal utility. This scenario arises when consuming an additional unit neither adds to nor detracts from overall satisfaction. An example would be reaching a feeling of fullness after eating several slices of cake. Eating another wouldn't enhance your experience. 3. Negative marginal utility. This happens when consuming more of a product leads to a decrease in overall satisfaction. For instance, after overindulging in cake, consuming a fourth slice may cause discomfort or nausea. Historical perspective on marginal utility. The concept of marginal utility was pivotal in resolving the water-diamond paradox, first presented by Adam Smith in the 18th century. This paradox highlights the difference in value assigned to necessities like water compared to luxuries like diamonds, despite water's essential role in human survival. In the 1870s, prominent economists such as William Stanley Jevons, Carl Menger, and Leon Walras independently contributed to the formalization of the marginal utility concept, explaining that the utility derived from the last unit consumed influences decision-making, rather than the total utility derived from all units consumed. Marginal utility versus total utility. While marginal utility evaluates the increase in satisfaction from consuming one additional unit, total utility assesses the overall satisfaction accumulated from all units consumed. Understanding the relationship between these two concepts is crucial for both consumers and economists. Example: if attending a seminar is highly enjoyable initially, the joy might decrease with each subsequent session, leading to decreasing marginal utility, though total utility may still be on the rise as long as sessions remain enjoyable. Calculating marginal utility. To calculate marginal utility, you can use the formula \text mu equals \frac delta text tu delta q where \delta text tu is the change in total utility, current tu, previous tu. \delta q is the change in quantity, new quantity, old quantity. Applications of marginal utility. Marginal utility serves several practical purposes across different sectors. 1. Consumers. Consumers typically seek products that offer high marginal utility, promoting repeat purchases and generating brand loyalty. When firms create products perceived as valuable over time, they tend to retain customers and foster long-term relationships. 2. Businesses. Businesses often strive to enhance products to maximize marginal utility so they can justify pricing strategies. A product with established high utility can command higher pricing if improvements are made, thus generating continuous profit. A key example can be seen in consumer electronics, where updates and upgrades are frequent in response to consumer demand patterns. 3. Governments. Marginal utility principles can inform public policy decisions, particularly in taxation. The theory supports progressive taxes, arguing that essential services have higher utility for lower-income individuals compared to higher-income earners. As such, it fosters a fairer tax system aligned with societal benefits. The bottom line. Marginal utility is fundamental in understanding consumer behavior, economic decision-making, and pricing strategies. By recognizing how additional units of consumption affect overall satisfaction, stakeholders can make informed choices. Whether crafting a marketing strategy, planning product lines, or establishing tax policies, the insights from marginal utility are immensely valuable in evaluating both personal and broader economic choices. With the law of diminishing marginal utility, we see a clear rationale for ongoing adjustments in consumption and pricing dynamics in the marketplace.